Investing in the stock market can be a daunting task, but with the right investment vehicle, it can be also a lucrative one. ETFs and index mutual funds are two such options that offer investors a diversified portfolio of stocks or bonds that track a market index without requiring them to select individual securities. But how do these investment vehicles differ? Which one should investors choose? Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. In this video, we'll explore the similarities and differences between ETFs and index mutual funds, as well as their respective advantages and disadvantages. We'll also dive into some of the key factors investors should consider when deciding between the two, such as trading style, fees, taxation, minimum investment, dividend reinvestment, tracking error, and transparency. By the end of this video, you'll have a better understanding of which investment vehicle best suits your investment goals and risk tolerance. So let's dive in and explore the world of ETFs and index mutual funds. Investors who are new to the stock market are frequently advised to begin by purchasing an index fund or ETF, which stands for Exchange Traded Fund. However, the lack of knowledge regarding the distinction between an index fund and ETF can be a major obstacle for individuals seeking to enter the investment world. Primarily, it is worth noting that the terms index fund and ETF are often used interchangeably. This is due to the fact that the majority of ETFs are designed to replicate the performance of an index, which is why people often associate ETFs with index tracking ETFs. Additionally, when people discuss index funds, they may be referring to either an ETF or a mutual fund that is used to track an index. Exchange-traded funds, or ETFs, and index mutual funds are two distinct investment vehicles that provide investors with exposure to a basket of securities that replicate a market index, such as the S&P 500 or the NASDAQ Composite. Both ETFs and index mutual funds are categorized as forms of passive investing, in which they seek to mirror the performance of the market rather than attempting to outperform it. Passive investing has gained significant popularity among investors who are keen on diversifying their portfolios, reducing their costs, and minimizing their tax liabilities. Notwithstanding their similarities, ETFs and index mutual funds have differences that may influence their suitability for various investors. As such, it is crucial to consider these differences when deciding which investment vehicle to utilize. Differences. While ETFs and index mutual funds share some commonalities, it is their distinguishing features that set them apart. These unique facets are 1. Trading style. The primary divergence between ETFs and index funds lies in the manner in which they are traded. ETFs are listed on stock exchanges, affording investors the liberty to buy and sell them throughout the day, similar to individual stocks. This feature endows ETFs with greater liquidity and flexibility, unlike index funds, which are only priced and traded once a day at the market's closing time. However, ETFs offer investors the advantage of leveraging advancing trading strategies such as limit orders, stop orders, short selling, and margin trading. Index funds, on the other hand, are not traded on exchanges but are available via mutual fund companies or brokers. Investors can buy or sell index funds only at their net asset value, or NAV, which is computed at the end of each trading day based on the underlying security's value. Unlike ETFs, index funds do not have bid-ask spreads or premiums or discounts to their NAV. Number 2, fees. ETFs and index funds differ in their fee structure. Both funds have an expense ratio, a percentage of assets that pays for the management and administration expenses. Since both types of funds are passively managed, their expenses ratios are typically lower than active managed funds. However, ETFs generally have lower expense ratios than index funds due to lower operating costs and economies of scale. Additional fees to consider for ETFs include brokerage commissions, bid-ask spreads, and premiums or discounts to NAV. Meanwhile, index funds have sales loads, redemption fees, and account fees. Sales loads are charged for buying or selling index funds, redemption fees for withdrawing money from index funds within a certain period, and account fees for maintaining an account with a mutual fund company or broker. These fees vary in type, size, and frequency of transactions. Number 3, taxation. ETFs and index funds differ in their taxation. Both are subject to capital gains taxes when investors sell shares at a profit. However, ETFs are generally more tax efficient than index funds due to lower turnover rates and fewer taxable events. Turnover rate measures the percentage of a fund's portfolio that is changed in a year due to buying and selling securities. Lower turnover rates reduce the chances of triggering capital gains taxes. ETFs usually have lower turnover rates than index funds because they closely track their underlying indexes and don't need to rebalance portfolios as frequently. Taxable events are situations that trigger capital gains taxes within a fund. These include selling securities, receiving dividends or interest, or receiving distributions. ETFs have fewer taxable events than index funds because of their creation and redemption process. This mechanism allows ETFs to exchange securities with large institutional investors without triggering capital gains taxes. Index funds may need to sell securities in their portfolios to meet investor redemptions or rebalance. This can result in capital gains distributions that are taxable to investors, even if they don't sell their shares. Number 4, other factors. When it comes to choosing between ETFs and index funds, it's important to consider a number of factors beyond just trading style, fees, and taxation. While these are certainly important considerations, there are other factors that can also have significant impact on an investor's decision. Minimum investment. One such factor is the minimum investment required for each type of fund. Index funds may require a minimum investment, which can be a barrier to entry for some investors. In contrast, ETFs only require the cost of one share and any brokerage commissions, which can be a more affordable option for those just starting out. Dividend reinvestment. Another factor to consider is dividend reinvestment. Index funds typically offer automatic dividend reinvestment plans, which can help investors grow their portfolio over time. However, ETFs do not always offer this feature, which can be a drawback for some investors. That said, some brokers may offer this service for a fee or even for free, so it's worth checking with your broker to see what options are available. Tracking error. Tracking error is another important consideration when choosing between ETFs and index funds. This metric measures the deviation between a fund's performance and its benchmark index. ETFs may have lower tracking error than index funds due to their unique creation and redemption process, which enables more efficient portfolio adjustments. This can lead to more accurate tracking of the underlying index, which can be an advantage for investors seeking to closely replicate a particular market segment or asset class. Transparency. Transparency is also a key factor to consider when choosing between these types of funds. ETFs are generally more transparent than index funds as they disclose their holdings daily, while index funds only disclose quarterly or semi-annually. This level of transparency can be useful for investors who want to closely monitor the holdings in their portfolio and make more informed investment decisions. These factors can influence an investor's decision when choosing between ETFs and index funds. Similarities. Number 1, diversification. One of the main similarities between ETFs and index mutual funds is that they both offer diversification. Diversification is the practice of spreading one's investment across different asset classes, sectors, regions, or strategies to reduce risk and volatility. By investing in a basket of securities that track a market index, ETFs and index mutual funds allow investors to gain exposure to a broad range of stocks or bonds with a single purchase. For example, an investor who buys an ETF or an index mutual fund that tracks the S&P 500 can own a small fraction of each of the 500 largest companies in the US market. This can help investors avoid putting all their eggs in one basket and reduce the impact of any single company's performance on their portfolio. Number 2, low fees. Another similarity between ETFs and index mutual funds is that they both have low fees. Fees are one of the most important factors to consider when choosing an investment vehicle, as they can eat into one's return over time. ETFs and index mutual funds are passively managed, which means they do not require active research or trading by fund managers. Instead, they simply follow a predefined set of rules to replicate the performance of their underlying index. This reduces the need for human intervention and lowers the operating costs and expenses of the fund. As a result, ETFs and index mutual funds typically charge lower expense ratios than actively managed funds, which can have fees ranging from 0.5% to 2% or more per year. Expense ratio is the percentage of a fund's assets that goes to pay for its management and administration costs. Number 3, tax efficiency. A third similarity between ETFs and index mutual funds is that they both offer tax efficiency. Tax efficiency is the degree to which an investment minimizes its tax liability to investors. Taxes can have a significant impact on one's investment returns, especially for long-term investors who benefit from compounding. ETFs and index mutual funds are generally more tax efficient than actively managed funds because they have lower turnover rates and fewer taxable events. Turnover rate is the percentage of a fund's portfolio that is changed in a given year due to buying and selling securities. A lower turnover rate means less buying and selling activity within the fund, which reduces the chances of realizing capital gains that are taxable to investors. Taxable events are situations that trigger capital gain taxes within a fund. These include selling securities within the fund, receiving dividends or interest from securities within the fund, or receiving distributions from securities within the fund. ETFs typically have fewer taxable events than index mutual funds because they use a unique creation and redemption process that allows them to exchange securities with authorized participants, large institutional investors, without triggering capital gains taxes. Advantages of ETFs over index mutual funds. ETFs and index mutual funds both have their advantages and disadvantages, and it is important for investors to carefully consider their options before making investment decisions. Here are some of the reasons why ETFs may be preferred over index mutual funds. Number 1, Tax efficiency. ETFs are known for their tax efficiency since they can exchange securities with authorized participants, which avoids triggering capital gains taxes for the fund itself. This means that investors are generally less likely to face capital gains taxes while holding ETF shares. On the other hand, index mutual funds can also be tax efficient if they are managed well, but they may have higher expense ratios than ETFs. Number 2. Lower expense ratio. One of the biggest advantages of ETFs over index mutual funds is their typically low expense ratios. ETFs are known for having lower operating costs, which translate to lower expense ratios for investors. In fact, many ETFs have lower expense ratios than comparable index mutual funds, even when they are offered by the same fund company. Number 3. Lower minimum investments. ETFs are also advantageous because they often have lower minimum investments requirements than index mutual funds. Investors can start with just one share of an ETF, which can cost very little compared to the thousands of dollars required to invest in some index mutual funds. While some index mutual funds may have small minimum investment requirements, investors who want to invest in specific sector indexes may have a hard time finding index mutual funds with low minimum investment requirements. Number 4. Greater liquidity and flexibility. Another advantage of ETFs is that they have greater liquidity and flexibility. ETFs are traded on exchanges throughout the day, which means that investors can buy or sell shares whenever the market is open. On the other hand, index mutual fund trades are settled in bulk at the end of the day at the net asset value of shares at the market close. Additionally, ETFs offer investors more flexible investment options than index mutual funds. Investors can put in limit and stop orders, use margin accounts to trade shares, and even buy option contracts on ETFs. Advantages of index mutual funds over ETFs. While ETFs certainly have their advantages, index mutual funds have their own set of unique advantages that can make them a better choice for some investors. Number 1. No commissions. One of the key benefits of index mutual funds is that they do not require investors to pay a commission to invest in the fund. Instead, banks make money from the expense ratio. This makes index mutual funds a more cost-effective option for investors who want to make small monthly investments. In contrast, ETFs often require investors to pay a broker to execute a trade for them, which can make them more expensive than index mutual funds despite their lower expense ratios. Number 2. Invest in dollars, not shares. Index mutual funds have no problem issuing shareholders partial shares, so investors who want to invest a fixed amount of money each month can be sure the entire amount will be fully invested. ETFs, on the other hand, require investors to buy whole shares on the exchange, which means that investors may end up with a little bit of cash left uninvested each month. This could potentially impact the overall returns that investors get from their investments. Number 3. Automatically reinvest dividends. Index mutual funds allow shareholders to automatically reinvest dividends paid out by the fund back into more shares. Since mutual funds keep their own records, investors who opt to reinvest their dividends will see transactions happen the same day the dividend is paid out. ETFs, however, do not always have dividend reinvestment options, and investors may have to wait for dividend payments to settle in their brokerage account before they're reinvested. This means that an ETF won't track the index as efficiently if investors are reinvesting dividends. Thank you for watching this video on ETFs and index mutual funds. We hope that you found it informative and helpful in your investment decision-making process. As always, it's important to do your own research and consult with a financial advisor before making any investment decisions. Remember, investing involves risk, and there is no guarantee of returns. However, by understanding the differences and similarities between these investment vehicles, you can make a more informed decision that aligns with your investment goals and risk tolerance. If you enjoyed this video, please consider subscribing to our channel for more informative content.